There's a common assumption about wealth. We believe it comes from intelligence, from talent, from superior decisions. We assume wealthy people must see things others don't, that they pick better stocks, time markets more precisely, identify opportunities earlier. But when you zoom out and look at the data, something different appears. Wealth does not cluster around talent. It clusters around time. This isn't an inspirational statement. It's not motivational. It's not about mindset or hustle. This is about how wealth actually accumulates in the real world. If talent were the primary driver of wealth, we would expect the richest investors to consistently outperform everyone else year after year. But long-term data tells a quieter, more mechanical story. Wealth compounds around those who simply remain invested over decades, not those who act brilliantly once. Today, we'll break down the math, the behavioral evidence, and the long-term data that explain why duration, not brilliance, is the dominant force behind wealth creation. And by the end, the way you think about investing may shift from trying to be exceptional to trying to be durable. Before we go further, we need clear definitions. When people say talent in investing, they usually mean stock-picking skill, market timing ability, exceptional foresight, superior analysis, the ability to predict turning points. In other words, being right more often than others. Now contrast that with time. Time means years of earning income, years of saving consistently, years of remaining invested, years allowing returns to compound. Here's the key distinction. Talent acts occasionally. Time acts every year. Talent may produce a brilliant decision once. Time compounds quietly, continuously, and without interruption. And that difference changes everything. Let's step away from opinion and look at arithmetic. Compounding is simple in structure, but powerful in outcome. If you earn a 7% return in year 1 on $10,000, you have $10,700. If you earn 7% again, you don't earn it on $10,000. You earn it on $10,700. Growth builds on prior growth. This process accelerates over time. Early on, growth looks slow, almost flat. The curve steepens later. This is why duration dominates brilliance. Using the rule of 72, which estimates how long it takes money to double, at 7% returns, money doubles roughly every 10 years. So, $10,000 becomes $20,000 in 10 years, then $40,000 in 20 years, then $80,000 in 30 years. Notice something important. Most of the growth happens in the final decade, not because the investor became smarter, because compounding accelerates with time. You do not need exceptional performance to build wealth. You need average performance sustained over long durations. Compounding rewards duration, not brilliance. Now let's look at real-world behavior. Year after year, the majority of professional fund managers fail to outperform broad market indexes over long periods. Over 15-year periods, most underperform the market. If talent were widespread and reliable, we would see consistent outperformance. Instead, we see regression toward the average. Even more telling, individual investors often do worse than the funds they invest in because of behavior. People buy after markets rise. They sell after markets fall. The biggest enemy of returns isn't lack of skill, it's interruption. Each time someone exits the market during volatility, they reset the compounding clock. Time works only when uninterrupted. The investors who build wealth are not necessarily those who predict best. They are those who remain invested longest. There's another misconception about wealth. People assume high income equals high wealth. But wealth is not built from peak income. It's built from lifetime accumulation. Net worth strongly correlates with age. Why? Because age is a proxy for time. Even moderate earners who save consistently over 30 or 40 years often accumulate more than high earners who save inconsistently. Consider two individuals. One earns a very high income for 5 years but saves little. Another earns a moderate income for 30 years and saves 15% annually. Who accumulates more? The one who sustains savings and allows compounding to operate. Wealth is built by what you keep and compound, not what you briefly earn. Consistency matters more than intensity. Here's where the argument becomes counterintuitive. Talent can actually reduce returns, because talent encourages action. Overconfidence leads to higher trading frequency, more strategy shifts, attempts at timing, reaction to short-term news. Investors who trade more frequently tend to earn lower net returns. The most confident investors often underperform because activity increases costs, taxes, and timing errors. Talent encourages intervention. Wealth rewards patience. The more intelligent someone feels about markets, the more tempted they are to interfere. But compounding prefers stillness. Time does more than multiply money. It smooths volatility. Over one-year periods, returns vary widely. Some years are negative, some are strongly positive. But over 20-year rolling periods, the probability of negative returns drops dramatically. Time reduces the pressure to be right today. It allows mistakes to fade. A bad year becomes a small blip across decades. Time forgives errors. Talent magnifies them. Because when you rely on being right in the short term, mistakes compound against you. When you rely on time, mistakes dilute. This is not about ignoring risk. It's about recognizing that duration transforms volatility into background noise. To be precise, talent does matter in certain domains: entrepreneurship, business ownership, innovation, concentrated equity positions. Founders can generate extraordinary wealth through skill and vision. But these paths carry high failure rates. Most startups fail. Most concentrated bets underperform diversified exposure. At the population level, time explains more wealth outcomes than talent, because time is scalable. Talent is rare, and talent combined with time is powerful. But talent without time is fragile. So what does this mean in practical terms? Start earlier if possible, because the first decade matters more than it appears. Stay invested longer, not perfectly, not flawlessly, but consistently. Reduce unnecessary decisions. The more decisions you make, the more opportunities for error. Focus on what you control: savings rate, asset allocation, costs, consistency. Avoid performance chasing. Avoid constant optimization. The difference between a 7% return and an 8% return matters far less than the difference between 10 years invested and 30 years invested. Time in the market outweighs precision in the market. Wealth isn't built by being exceptional once. It's built by being average for a long time. This removes the drama. It removes the hero narrative, but it replaces it with something more powerful: reliability. Time is not passive. Time is the active force. It compounds earnings. It compounds savings. It compounds returns. It compounds behavior. Talent acts occasionally. Time compounds relentlessly.